Is the state of the market in multifamily just a little bit too clear right now? That might be a little troubling. It's interesting. Marks and Millichap's just put out a piece asking the question, is now the time to buy multifamily? Let you guess what their answer is. Two pieces from Marcus and Millichap today on the Gray Report. One on, is it time to buy multifamily? And then on another one, what's holding all this sideline capital back? There's all this dry powder people keep talking about. There has been for years. Why hasn't it been deployed? Well, we've got a nice post from Jay Parsons that might explain a little bit. There's a lot of excitement for assets that have not broken loose just yet. We'll get the details, but also on which assets and where actually might be distressed and they could be really attractive. But also related, from apartment lists, more than half of renters are cost burdened, according to new census data. That's not good. We're going to dive into the details and see what that means. But attempting to help the problem, Fannie Mae is coming out introducing sponsor-dedicated workforce housing financing to support workforce rental affordability. Is this a silver bullet? Almost certainly not, but it might help a little bit. So we'll get into the details and what that might mean for renters as well as investors. And another piece from Fannie Mae, really dropping some big ones today, multifamily and economic commentary for October 2023, rising number of multifamily properties offering concessions. We all know that the market is a little bit softer with all of this supply coming online. And then lastly, from RealPage, here's the most unexpected twist of the apartment sector in 2023. Stick around for the full episode of The Gray Report. Make sure you're subscribed to the Gray Capital YouTube channel. Give this video a like. If you're an active investor, passive, anywhere involved in the multifamily industry, this is the show for you. We're going to be breaking down all of the latest research reports, data, throw out some original commentary from the Gray Capital team. Sit back, relax, strap in. We've got a great show. Watch the whole thing. All right, let's get into it. Welcome back to the Gray Report. Dr. Matt Bosnagel, Director of Communications and Marketing, producer of the Gray Report. Thanks again for being on the show, Matt, putting it all together, making it happen.
It's good to be here. Yeah.
Good week.
I feel, I think you mentioned this earlier, I feel some clarity in the market, a little less uncertainty. Maybe it's a little too clear, but some of the clarity is about things to avoid for sure. And we've there's almost some sources that we're getting to the point here at the Gray Report where I think we have a good enough handle on the market where we can figure out a little bit about where the sources are coming from, where some of the data that we are getting from these reports may or may not have, I don't want to say an agenda, but there's ways, but maybe, they're picking and choosing a little bit.
Yeah, I think that there's probably a little bit of grasping here and there because some things are very clear and it's not always the narrative that everyone always wants to hear as well, especially if you're in the business of doing deals and making deals happen.
Yeah.
A lot of the brokers are. Now, a lot of brokers are still doing deals. We had the Cushman & Wakefield team on recently. They've done, a ton of deals this year.
Yeah.
Volumes are still down, but we do know the volumes are down. So it is hurting, again, not just brokers, but, syndicators, who are looking, have traditionally used those transaction fees to kind of fuel their business and their growth. And, we've talked about this on the show before, Matt. It's just this period of uncertainty and not as much price discovery, not as many deals happening. Mm-hmm. The longer that goes on, the more pressure it puts on the industry itself. And a lot of it also, the longer it goes on, the prices seem like they are going to continue to lower because, it's like the market moves so slow.
Yeah.
And when COVID happened, everyone in their mind, knew for a second, or if you would have, everyone sold their real estate in, April or May of 2020, if like everyone had to sell to somebody, the prices would be like much lower. But there was very few actual transaction activity that took place during that time. So like, did the prices really fall down? Did they decline? I mean, in people's minds, they may have. Mm-hmm. Everyone was looking for this COVID discount. I remember having conversations like, "Are you seeing any discounts?" And for a minute, there was like 5 to 10% off of the price. That was being talked about. and maybe a couple people bought some deals at a little bit of discount at that period of time, but it really never materialized. And what actually happened is, the Federal Reserve, brought rates to zero. We started pumping money into the system. Everything took off, and cap rates went down and prices went way up. But it's because that period there wasn't enough time for anyone to be forced to make a decision, to start to transact, to start to discover where prices really were. And before we could get to that period, we were already off to the races with rent growth and all, the story of 21 and 22. But today, so the longer it goes on, the longer that there is uncertainty, the higher the probability that prices could move to the downside if we're still in this higher interest rate environment.
Yeah, and I think that the other big, huge elephant in the room factor, the difference between 2023 and 2020 is the interest rates were relatively low in 2020. Yeah. And in 2023, they're high. And, that could be the determining factor where, it was investable. The math worked in 2020.
You're going to say, took the words out of my mouth, Matt. Yeah. The math worked. When you were looking at it in 21 and 22, and you could borrow, mid twos, mid threes, and your cap rate is, maybe, starting at 5%. That also made a lot of sense. We were actually looking at one of the all-time highs in the spread between interest rates and cap rates. I mean, we did videos on it. It seems scary, but right now is actually a great time to buy because of the math. I remember we did it on the whiteboard.
You remember that?
This big spread, and now the math is doing the opposite. The spread is the highest it's ever been. And actually, I saw a post today on LinkedIn, Matt. It was cap rates for single family homes. I don't know why who's using cap rates for single family homes. It's fine, but it basically they're saying that they finally have inverted. Interest rates, mortgage rates, and single family home cap rates have absolutely inverted.
Oh, wow.
And it's the same with multifamily cap rates. If cap rates are trading, at 5%, but the interest rates are mid fives on the short term, even the 10-year treasury, is what, 4.8, today it's getting close to 5%. Cap rates were trading a year ago, at 4.5%. And brokers were saying for a long time, no, we're still in the 4.5%, maybe 5% range. We can't be inverted. I mean, this is the first time the spread, to my knowledge, has absolutely has inverted and gone negative. So it's the math is staring us in the face.
You can't. It's so true. It's like the starkest reasoning. You can talk about what may happen, the value add that you may do to bring yourself out of negative leverage or something like that. But that's all speculating on. That's the other thing to think about too, is speculating on a very risky 2024. 2024 is not going to be a return to normal like many are maybe expecting.
Yeah, I'm glad you brought it up, Matt, because it's a nuanced subject. Yeah. Like there's not, people have heard us say a lot. We're not buying negative levered deals. We're only going to use positive leverage. That's primarily because a lot of the deals that we're looking at aren't big value add plays. We're just not seeing the ROI in those opportunities. Maybe we've done a lot of those. One day I could see it maybe coming in the next couple of years. So it could be a big opportunity. But what's happened is the spread between the cap rates and the value add deals have always been much lower, typically because the idea is you can force appreciation, you raise the rents, and you're not buying a stabilized asset. You're not looking at the returns based on just today. You're going to you're going to execute a business plan.
Okay, good. I have that in my notes, and I'm so glad I actually learned something. So.
Okay. But so if you're going to bring on $2 million to renovate units to increase rents, so it's more equity you're going to have to bring on, to say, because you could look at it and we talk, when we have the value add deals, we'll look at, okay, well, what if we don't get any, what if we can't increase rents? Well, we do all this work, you spend all this money, but you can't get any return on it. What does that look like? Now, it usually doesn't look very good. That's why you have to do your research, pick your locations, and be confident that you can, achieve those rent premiums. And it would make sense in an environment where there's not a lot of organic rent growth how else are you going to get it? Okay, you have to force it and make it happen, make these units better, actually show the value to the market. What's tough now, though, is unlike a couple of years ago where there wasn't that much being delivered, just a little bit. You know, you go into that C-class property and, you know, you spick and span it up. It got a granite countertop, new cabinets, LVT floors, the whole, you know, the kid and caboodle, you know.
Yeah. Tell me more.
You know, you could get a couple $100, you know, per rent premium because the new development was $500, $600, $700 more. Yeah. But in the last couple of years, rents of all properties have increased by 20%.
And that spread, which there's that Real Page article this week, that it's compressed. There is a smaller gap between A, B, and C apartments.
The cap rate spread has narrowed. Also, the rents narrowed. All of a sudden, a lot of these B-class properties were pushing kind of close to the A-class. All of a sudden, there's only like $100 or $200 difference. Yeah. And now there's all these new deliveries, new apartments that are being leased up. They just were built, and they're trying to lease those units up as quickly as possible. So they're not, you know, they were like, we're the new thing in town. What's the craziest rent you think we can get? And they'll put it out there and they'll see if they can lease it up. Obviously, they will want to lease it up quickly no matter what. But they were pushing. They're pushing. Now let's see where we can push it. Let's just get it leased up. You know, and so what they're doing is, what's a property that's a couple years older that we can like move our rents down to and just try to steal occupancy from that property. And so getting back to the value add piece, you know, if you're trying to charge $2,000 for a 70s built product that just has some granite countertops in it, when I can go across the street or go into a better part of town, most likely, and rent something for $2,100 that has better finishes and better amenities in a better part of town and all, you know, the rest. That's a hard sell. So it's less certain in an era of a lot of supply coming online that you could always execute that value add. But not that you're saying you can't, but it's to your point, there's risk associated with it. Yeah,
it's such a more risky environment now. And value add already had a bunch of moving pieces. You know, are you going to get it built in time? How are you going to get the people out of there and turn it around?
The execution risk.
And I also think, and this is something that you've said too, you can upgrade as much as you want a 1980s building. There is a feel, an architecture, a floor plan, call it what you will. Renters will come in there and they'll know it was built in the 80s and they will prefer the newer one.
I used to love like the idea of buying like old stuff because like I just thought it was cool. That's what I thought it was an apartment. Matt, you and I, when we lived in apartments, it was a different age. The mindset was different.
Yeah.
We knew our expectations were low.
Yeah.
They were much lower than those of today. Right now, it was pre-student housing. Think about the new demographic, this new generation that's gone to school. They lived in high-end student housing, probably their parents paid for, with all of the finishes, all of the trim, the pool, the huge pool with the big screen, with the media center, with like the massaging chairs,
and the environment around it has maybe it's mixed use, or at least it's like adjacent to kind of attractive areas where that's happened because the new builder has figured out the best place to build, and the community may have moved away from the older building's location.
Yeah,
but
often and. The point is, the preferences are much bougier than they once were. And so you got to really compete.
Yeah.
And not that there aren't a lot of folks out there that are just looking for a good deal, clean, safe place at a good value. There's a lot of that. But the largest growing segment of renters, again, in Gen Z population and younger millennials, they want something that's really nice. And they aren't being fooled by the 60s and 70s, granite deal with a granite countertop when some down the street.
Yeah.
So but that is, I don't know if this is where we want to move to it, Matt.
No, this is perfect.
Let's talk about, is it time to buy multifamily?
Yeah.
Or?
So yeah, if we want to move into these, it's a pair of Marcus and Millichap's videos. From the first is from John Seabury, friend of the show, and the next is from another friend of the show, John Shang, and they both regularly have great information. I think that it's interesting. There's an informal law of headlines that says any headline that ends in a question mark can be answered by the word no. Well, with apologies to that law's author, the answer to this John Seabury video is an emphatic yes. Right out the gate, John Seabury describes investors being very, very aggressive in pursuing multifamily deals because now is the time to buy. And he says, the approach to the market for these buyers has to be finding a strategy, which is, you always got to have a strategy. But it means finding a target cap rate and understanding exactly where interest rates are. And he's kind of arguing for the viability, in some cases, of negative leverage. And he's invoking, the potential.
He's saying don't be too afraid of it. He's like, listen to us, and he's like, hey, no, it can work sometimes, which is true. Yeah. And again, that was my point earlier, Matt. Mm-hmm. It is nuanced.
Yeah.
But it also should be highlighted that there is more risk when you go negative leverage. You are counting on additional things needing to happen in your business plan to achieve what should be a higher return than one that uses positive leverage.
Yeah. And he does say establish your criteria. He notes, maybe cap rates will be 5.5 or 6, probably not going to be 7 in today's market. Although, as we have maybe said, if you look at cap rates as commensurate with interest rate changes, maybe it should be a 7, but it ain't going to be right.
But Matt, do you feel, and this is the broader point that I wanted to ask you about, do you feel like there is a push? I guess I've noticed a push recently for brokerage houses coming down, really needing to put some support out there and maintaining a narrative. And they're publishing the vast majority of the pieces and research that comes out in the industry, right? There's definitely a narrative to get buyers re-engaged and to come into the market.
Yeah.
And on one hand, we can take it at face value, saying, okay, the guys that are selling the apartments are telling us now's the time to buy the apartments. Maybe they know something and they're smart. They're close to the market. They make some decent points. But they also, it almost seems a little desperate.
Okay, so that's kind of what I was getting at when I was saying it's kind of my feelings.
Why would they need to do it? Why would they need to say you need to come back into the market?
And when I first saw this video that John Seabury put out, he talked about buyers being very aggressive in this market. But if you look at the numbers that he is citing, and if you're aware of your own experience, maybe as an investor or a syndicator, that's going to be different than a broker's perspective. First of all, and second of all, if you just dig into the numbers a little bit, you may come off with a different idea that people are jumping into the market.
I guess whereas the long term, well, here's what makes sense for me, where it's a good time to buy right now. This would be my argument.
Yeah.
Okay, it's make a case it's a good time to buy. We're seeing values that are coming in close or below replacement costs. Yeah. So there's some good basis opportunities to buy high quality projects in good locations, and again at good relative values to what it would take to build them. That sounds attractive. The returns, though, are rough.
Yeah,
they're not commiserate with what you would want to receive in compensation for the perceived risk going on in the market now. Yeah. But now, where you could be smart for taking on the basis right now is we have bottomed out. If prices start going up and if this is a huge, just recovery, and all is good, that would make sense. But I don't see there's enough short-term headwinds, like short as in a year, where it's hard to get so excited of now is the time, because it feels like we still have to get through some stuff before we can be that confident. But now but that being said, is it?
That's what
the fear and the uncertainty. Everyone's running away. Now it's time to get in.
And that's what watching this video, and I shared it with other people from Great Capital, and I said this scares me a little because were we way off? That was what I was scared of. Our cautiousness in the market, was that unjustified? And I returned to the numbers and I looked at things again, and I was like, no, I think that we're still justified in holding off, or at least Or at least being more careful now and not being as aggressive as he describes it. But I do think that,
that's what they want you to be. They're saying you need to be aggressive. They're not like they're saying you basically need to go out there on a limb because it's like we want to buy stuff. It's not like where we've gone out and said, stop looking at deals. We are not buying anything pencils down. It's like we're trying to make the numbers work, and we're just like it looks like garbage, and people are saying get aggressive with it. Go just do it anyway. And I'm like, the numbers don't work, the math doesn't work, and you're just saying just get in there.
Like, So that was I do agree though. If it does meet your criteria, you better jump on that quick, because there's not a whole lot that is on the market.
And the criteria and. That's the reading between the lines is that if your criteria is like, you can clip a small coupon and I don't need a big return and I have to diversify into commercial real estate because I'm a large institution, that makes sense. And like if I had $1 billion of cash, I would probably buy some multifamily right now. Yeah. Because now, do you buy the $1 billion of multifamily or do you sit in treasuries making 5% and buy in 6 months from now? That's the question. Yeah. And I think that you'd look for opportunities, and there's really two philosophies. Do you dollar cost average in, or do you wait, try to time it a little bit, which never really works out that well. But basically say you're going to wait until X occurs. We're going to begin in Q1 of 24 or Q2 of 24 because we believe X. And if it hasn't bottomed by then it's not going to bottom, and we're off to the races. I wouldn't go all in right now. Yeah, I think dollar cost averaging going slow right now, like still finding some opportunities. But man, I'd want the big war chest. I'd want to have the $1 billion in cash for like early next year. Yeah, I think isn't that the way we should look at it? Like, okay, you have got to, because it's all theoretical. If we're like, it's now the time to buy. It's like, I don't know, but if you have the money, if it's real, what would you do with it right now? Yeah, and that was my Powerball plan, by the way. If I won that Powerball, wearing less. Man. The biggest investor. Yeah, that would be great. You get a title change.
Oh man. But anyways, I do think that this is what I kind of come back to.
Should buy everybody lottery tickets.
Yeah. Well, I mean, let's get aggressive about that.
Get a little pool going.
Get aggressive on the lottery. My point, kind of coming away with this, and with a following piece from John Chang, is the first year after taking over a multifamily investment property can be rocky anyways, because you're kind of implementing a strategy. There's some turnover, especially in a value add project. But if you're going to jump in and get aggressive in an environment with today's pricing, then 2024 is going to be a huge drag on returns. Anyone that does buy at the current cap rates or anything, even if they are, need to keep the lights on and just keep these transactions churning, I'm sure that they're almost writing off 2024 because it's going to be such a drag. And
they're using 2025 as year one.
I guess. And my other point too is like, some of these people that are churning through deals that's kind of their business model. They may have shorter time frames, and what if that 2024 is half of their investment cycle? And I just would caution against that, or maybe if you have a long-term plan, that may make sense to buy now if you've got like a 10-year hold, and you can kind of dilute whatever rocky environment.
I can't imagine putting a business plan together right now and needing to get like 20 or 30% rent growth over the next 3 years, and putting that in, not that I couldn't imagine it, but putting that in a pro forma and telling an investor like, this is what we're like we need to achieve.
And that's the kind of performance that you would need to justify current cap rates or
general. I mean, it would be a good problem. Most likely, if you're going to spend the money, we're going to go back to kind of that value add or any kind of assumption that you would need that. But it's you keep making really good points, Matt, because we got the price, the interest rates, which are tough, the performance, and we have just a slow year, and you really can't underwrite much rent growth. I mean, 3% is, maybe generous for most people. Most people you mark it as a zero. And if you've ever underwritten multifamily property, the rent growth is compounding. If you grow 1 year, the next year's growth is off that higher number from the year before. So, you're instead of 3% on 3% on 1,050 is higher than 3% on 1,000, and then it's the next 3% on it's 3% plus every single year.
Yeah.
If you lose out on the amount of compounding if you have low growth in the first year. That's why one trick underwrite sponsors will do is they front load all of the growth in the year one. And so you're doing a reasonable amount of compounding off of that initial number.
Mm-hmm.
Some will do it of just it's actually in year one. I've seen some where the growth is in year zero, and the imagined story is that all the work is done. What they're trying to show it's like a stabilized reform of like once we've done a lot of work and execute our business plan, this is what the yield is going to be. But then I'm like, okay, what about the time to get that? There.
Yeah.
Time value of money, once you factor that in, if you have 2 years of zero or 1 year of zero or 1 year of, that average and time, based return metrics all start to get thrown off. So it's to say like now's the time to get aggressive. part of me wants to like believe them and just say like, oh, all the data is wrong. Like, wouldn't that be great? That like there's gonna like, no, like we know that there's gonna be an explosive rent growth ever. And that's the other thing. They're talking, if they were saying like, hey, really not great news for these parts of the country, but there's some areas where, really you want to focus on, there could be some, these are the areas where you're going to find opportunity, but they're just like kind of saying generally.
Yeah.
And which I think maybe that's all that needs, like maybe to kind of tip the hat a little bit, tip the hand a little bit of like, if we're just speaking in such general terms that cannot really be true. Now, it cannot be the case or not.
Okay, so that's a good segue from John Seabury, and then almost as if to answer or response to that one from John Seabury, his colleague, John Chang, is asking a similar question: what's holding sideline capital back? And he summarizes it with a few main categories.
That's dry powder.
Yeah, there is dry powder, and if you can pause it or whatever, I do want to say this right now: is we've seen dry powder and we've seen it invoked throughout the pandemic.
I don't know if it means anything. It never goes down.
Yeah, it never goes down. Never seems to. And I honestly believe this that this dry powder.
It sort of went down, I guess, between 2020 and 2021, 2022.
Yeah,
but marginally.
Yeah,
but like, is it like?
It never goes down. They didn't dump at all from 2021 to 2022. I don't think that it dumped and then got refreshed from year to year. I think that what happened, I think that dry powder is looking for a really exceptional opportunity. I don't know specific numbers currently, but I remember reading what is dry powder earmarked for, and it's all earmarked for these opportunistic, distressed investments, these kind of like Cinderella ideal world investments, and that's great if that's what you want to wait for, and that's maybe worth waiting for some of this. But I don't think that it is a completely accurate measure of the investment dollars that are directly going to go into the multifamily market.
Yeah, I don't see a whole lot of correlation between like money that's thinking about going in and the money that actually goes in. I guess to some degree, but basically saying like there's a lot of money that's interested in what at what level. I have conversations every day of people who are greatly interested in multifamily and real estate. Like hugely interested, but it's under certain conditions that aren't present today.
Yeah.
And to say that these are the conditions, they're saying now is the time to buy today because all the money is available. Well, that's not really it's kind of a circular reference.
Yeah. Because the dry powder could be building up due to its unacceptable conditions. It's not being deployed. That's why it's rising.
Exactly. It's the unacceptable condition preventing it from being deployed.
Yeah.
But then they're saying the conditions are acceptable because the money is being allocated for the asset class, but not for the reason.
So that's just my little thing on dry powder. But to get to the actual answer. I
also was curious. Sorry, go ahead.
Yeah.
And while you do that, I'm gonna see if I can because their source it's a Preqin, and I think we have access to that.
Yes,
I was gonna maybe pop in real quick if I remember.
Yeah, just to give a little summary of the reasons why John Chang says that capital is being held back, market uncertainty, and then there's also a belief that property values are still still overpriced, and relatedly, prices are too high, cap rates are too low, and finally, there is an unwillingness to use negative leverage. I will add a few more. I think as maybe like a forward-looking perspective that sees a 2024 where interest rates remain high, rent growth is as sluggish as it was this year, prices are projected to decline further. Really, CoStar's price projections through 2024 is a fairly linear downward trend. Now, that's exactly what do they know. But also, and finally, like a long expected recession is still possible, if not maybe probable. I read somewhere that
it's 0%, Matt.
48% is what
48%.
Yeah. Depending on what side of the aisle or how exhausted you are with things. Do
you think Biden's gonna run? Are you gonna be like? It seems too like. Have you seen? Talking not tangent, but relative to recession and the election, obviously there's a lot involved. He just seems so tired. I'm like, man, the guy's tired. Anyway, go ahead, Matt. But
putting aside all of the political implications of economic performance and how that may actually factor in these economic projections, it wouldn't make sense if there wasn't an economic downturn that is more pronounced than what we've seen in 2023. Going back to what John Chang says, he's talking about, now he says, all those points are fallacies. He didn't really address all the points. The only points that he says there's a real fallacy is negative leverage. He says that investors are more than willing to take on negative leverage if they can project enough high rent growth or interest rate reductions in the future, or just have a plan that will let them kind of overcome their borrowing costs with NOI growth. John Chang does say interest rates could decline. But I say, they won't decline enough, I think, to justify current multifamily pricing. He brings up the dot plot at the end of the year. The dot plot's supposed to, it's going to be maybe 1% lower by the end of 2024, but that's still, that's the end of the year. Yeah. You've got a whole year to go. And he also notes that investors who are getting a jump on the market are those with solid value creating strategies. Just what we discussed. This is what I wrote in the notes is like, who is, a value add could elevate your income, but who's to say that the capacity for a value add renovation is already priced into the asset itself? They're pricing in that capacity for an increase. And also in an environment where so much new supply is coming on the market and demand and rent growth is not the sure thing that it was in the past, that value add investment, which already is more profitable because it's more risky, that value add investment becomes more risky. He does mention that investors should be forward looking, and he is smiling. He smiles a little at the end where he says, keep your eyes on the horizon. I think that's fine. And maybe he knew the humor in it, because I can picture a sailor that a sailor's eyes are on the horizon, really just right locked in there on the distance, but then he misses the rocky outcroppings, shark infested waters. And man, that pesky Moby Dick's about to ram the side of a boat. But, if you ignore 2024 because you're looking at 2025, you're going to miss a lot, and you may have a real drag that's going to really hurt you. Yeah.
I found some information on dry powder, Matt.
Okay, good.
So, it's interesting. Let me see if I can have our screen sharing technology is set up the right way. So there is still a lot of dry powder out there, but man, it is going down. It was continuing. Basically, 2022 was, incredibly, still, hot at the beginning, but then basically lying with interest rates going down. We've seen AUM or dry powder starting to come down, more and more.
That's interesting.
So now I think we're kind of in the beginning of this. The last time we saw really moves like this were, in 2009. And it was peaked. Again, we had issues in 2008. And so the plugs didn't get pulled until we were kind of in the thick of it. Because it's like, there's money out there, but it can't be deployed into just anything. And so, we are seeing, again, money is getting tighter, credit is getting tighter, equity is getting tighter. It's what you've been reporting on, Matt, in the reports.
Yeah.
Check out the link below. They'll ask to see reports on loan maturities that are coming up and rents across the nation. I mean, it makes a lot of sense that when debt and equity are just much tighter than they've ever been. I'm breaking it down between different types of real estate kind of funds and where people would like to allocate to. I mean, we talk about value add. In 2022, there was $140 billion that was allocated to real estate value add funds. It's down to $11 and $14 million, a drop of $30 billion. Now it's still up from 21, where it was at 111 billion in 2020 when it was 112 billion, and even higher than in 19 when it was 99 billion. But there's also, I mean, we've had a lot of money was made in these couple years. Mm-hmm. We've had a lot of inflation, so these obviously are not inflation adjusted.
Yeah.
But we've seen similar declines across the other types of strategies. I'm trying to see where there's any increase. There's really not.
It's interesting, at least in the opportunistic side, which is the largest portion of dry powder. It decreased more in the past year than it ever did increase.
This is interesting that the real estate secondaries has increased. Secondaries is, private investments.
Oh.
People are selling their positions. The deal's still going on. I'm in a fund. People selling out, whether that's, invested in Blackstone, any type of private fund. It looks like more and more people, this has increased quite a bit. 8.2 billion, 9.7 billion in 2022, and then all the way up to 10 billion of secondary.
Looks like that may be the only category.
Dry powder. So these are positions, dry powder to buy positions.
Yeah. It looks
people
like
selling out.
Maybe that's the only category that it increased. Oh no, real estate co-investment. Sorry, increased slightly.
Yeah. Okay.
But these are the smaller categories. The big
and this could be lumped into sort of distressed or opportunistic strategies. It is interesting. Specifically, the real estate distressed has gone down significantly.
Yeah.
It went way up relative to COVID and has come down. I guess people started getting a little bit more specific, and there just wasn't any distress. I think the point here, Matt, is that there's a big lag between dry powder and how it gets reported.
Yeah.
And to make any correlation of, well, the dry powder is high, therefore it is a good time to invest.
Looking, if you want to examine the drop off of investment, man, there's no more drastic of a graph that you can see here from 2022 to now. Now, I don't know if they are. This is a year-to-date number, so maybe, it'll be less steep, but it certainly seems like the decrease from last year to
year-to-date, so it may go up, but right now we're basically at 2013 levels.
Yeah, like this decrease almost certainly will be more than any one increase that we had in the amount of investment on the run-up when rates were low. That's how much investment has decreased.
So maybe not as much dry powder.
Yeah.
Again, we're beating the dead horse, Matt, but again, the point is pointing to an older graph of dry powder, like aggregate dry powder, may not be the best tool to use in determining if it now is the time to jump in and buy a multifamily.
And even on like a more meta level, the reason why I am a little bit more confident speaking to this is because we've been following it and we have data from different perspectives. One of which is people like Jay Parsons. They're not necessarily in the brokerage business, and so sometimes they can talk about. And Jay Parsons had a LinkedIn post this morning that said, people are waiting for things, and it's not necessarily that people are jumping in right now,
and they're waiting for things that everyone's kind of waiting for the same thing.
Yeah.
They're waiting for new newly constructed deals, good deals and good locations at a steep discount.
Yeah.
I
love the best. Can I just get the best?
Well, the best thing for the lowest price.
Yeah.
And what he's saying where the distress is going to be, because those are most like relatively sophisticated developers and owners that are doing those. They're generally well capitalized. They may have access to some of the rescue fund, prep equity, internal capital calls. Where there's going to be the most distress, and it's going to be who's going to take the bite, it's going to be in kind of workforce housing, C through kind of B class, older properties, the stuff we were just talking about.
Yeah.
That, the newer generation isn't super, just jonesed about. They want the nicer new stuff. But there's going to be a lot of stuff that was built in the 60s, 70s, and even 80s that there's not going to be nearly as many buyers for. And then you're going to see you're going to see the return to the spread that we talked about that has tightened between kind of the Class A and the Class C.
Yeah.
It should kind of expand again. Like we may see a version coming around to where older deals that are a little rougher are going to trade, in that 7 cap range.
Yeah. Well,
maybe the new deals still stay in the mid 5 caps just because people are willing to take negative leverage. Even though they're not going to force appreciation, but just because they want to lock in the good locations they don't think the price is going to get that much lower marginally, but they are confident that in 2025, 2026, we're going to see some really solid growth. And over the next 10 years, you're going to win. Like the price is going to be way more expensive. And so there may be more risk in missing out if you are capitalized well enough. And you're okay with some low returns in the first couple of years. Yeah,
that's why I am holding back from like completely refuting what John Chang and John Sebring says, because it's going to be a good investment. The fundamentals are strong. I just don't know. So much is going to depend on the attitude of investors and how if there's a consistent excitement throughout 2024, that's great. But again, the math is just so hard for me to refute at this point.
Yeah. Especially again, specifically in like common equity. Because if you're, if you're like, I want to invest in multifamily, well, maybe you invest in preferred equity and get 14, 15, 16% total return with taking less risk. Like you're still allocated to the asset class. Maybe you miss out on getting that 30% IRR in return, but better than the 12, 13% the common equity looks like they're getting. So what's the point? Matt, let's move on. Fannie Mae. Well, first do this apartment list because that kind of sets it up.
Yeah, just to kind of touch on this, the headline here for this apartment list article is that it says more than half of all renters are cost burden, according to new census data. Rent increases in the past 3 years have increased at a faster rate than incomes. It's pretty clear.
Makes sense.
Now, if you followed the recent CPI report, you'd notice that housing prices actually, in general, have gone up month to month, but notably the prices and I think associated lending costs of buying a home have also gone up.
Yeah.
Yes, rents are going down as a CPI measurement, but man, as an expression of housing demand, sure, housing prices are going up. But we're still at this cost burden status for a larger portion of the population now. And a caveat is that this cost burden figure probably includes both affordable housing and market rate housing, but it does illustrate a meaningful trend for renters in this increase, and it helps to explain how renters maybe have been a little resistant to rents going up and up. There is kind of a ceiling that we've,
renters don't like rent going up. I thought that.
Yeah, well, they never like it, but that's why it seems like a hard ceiling. Like they just won't pay it. They won't. For those.
No. Well, and now they've got the leverage now to push back. So they'll just go down the street.
And so that's kind of where we are. And you can talk a little bit about rent growth and renters choosing, when they're getting a new lease and they have that agency. And that's one thing, but also, renewals, maybe your renewals and that has been, it's weighed down on people. And it is, it's a direct result of this housing affordability crisis that has been ongoing. And ultimately, there's not enough housing supply. So That is the context that I could, that this apartment list article really very accurately paints. No real qualms with that. It does have a really great map here that shows the regions, especially the southeast and the southwest, are the ones.
It's getting hot down in Miami.
Man, really,
South
really
Florida.
High costs.
Smoking.
In like Southern California and Southern Florida specifically. Midwest seems like the area where there is the least amount of cost burden, but even some enclaves in the Midwest are about, the national average is a little over 50% now. So
wow.
Not great from a renter's perspective. And it's something that we have definitely been following, and we have said maybe the solution isn't giving everyone a 3% rent or 3% mortgage, but that's kind of like a Band-Aid solution. But really, you're looking at these deregulation or these or policies that put incentives on the side of suppliers, giving the suppliers the money really to build more. Now. That's what this Fannie Mae article details. It is, it is a new program that they have going that will make it more attractive to build affordable housing.
Yeah, I was interested in seeing that come across the wire recently, Matt. And again, really good segue between the two. So tell us about this new program that Fannie Mae has for workforce housing.
Yeah, much like Rob Warnock and the research team at Apartment List, and not to mention Evan Popov, who we also love. Fannie Mae is paying attention to the affordability of rental housing in this new program called the Sponsor Dedicated Workforce Product, SDW. It encourages operators to maintain income-based rents for at least 20% of the units in their properties for the lifetime of the Fannie Mae loan. And this really could be
just the loan. So there's nothing going on the deed. Just loan covenants.
This could be an effective way to address housing affordability. Again, probably better than a blanket 3% lock-in mortgage rate, even as nice as that sounds.
What's the carrot? Did they go into the what's the carrot? Because you wanted to raise rents. I get that, but
now that article says they say more attractive. What is it? More competitive pricing and lower interest rates. That's, a blanket term. And that seems like the biggest money related draw. They have a separate document there that details the kind of specifics of what this would entail, which is, it's like 80% LTV, a 1.25 DSCR. They don't have specific interest rates that they're offering, but you can apply for it, or you can look into it, and if they're saying it's cheaper, then it could work for people.
I think I'm having lunch with some folks from Fannie Mae tomorrow, actually.
Oh,
and so I was going to ask them about this. So
that's great.
I will report back. Let's see what the term sheet says, though. Term 5 to 30 years, amortization up to 30 years, not hooking us up with the 35-year AM. Don't know why. I'm sure they can. But let's just read from the top. Better pricing, more flexible underwriting to incentivize the creation and preservation of units that are affordable at up to 80% of area median income, or in certain metros up to 100% to 120%. So 80 to 120% of AMI. 5 to 30 years. They could have a 30-year term. Interesting. Amortization up to 30 years. Interest rates only fixed and variable rate. Structured ARM loans with a lockup period of less than 2 years are not eligible. That makes sense. They don't usually do that. 80% LTV, sure, not today. Minimum DSCR 125, makes sense. Modification of loan agreement, sponsor dedicated workforce housing. They've got a form. Interesting. So there's really nothing. So the borrower must annually submit a certification of compliance via the Supplemental Annual Loan Agreement Cert Form 6620 and rent rolls. So you gotta, looks like recert every year. There could be worse things. But yeah, there's not a whole lot of details in here. Again, are they... More. So what are those? So Matt, tell me, are they...
My guess?
Are we limited in the types of, do the rents just have to stay within the AMI band? Or like, are they posting what their max rents are? A lot of times, like HUD will like publish max rents. I'm just curious of like what the mechanisms are.
Well, I mean, they say 80 to 100% of AMI, and that's that. I would
that's
ask,
what they're saying that it's who it's for, but what are they telling you have to do?
Well, I know they kind of leave that blank, and I was going to ask you the same question. They're saying yes, hold it to people that are making 80% of the income. So what do you set those rents to be? Do you set those rents to be 30% of that 80%? So let's say the AMI is of an area, people make 100 grand a year for that, and so then you set rents to 30% of 80. Is that what you would do?
More, yeah.
Okay.
Well, yeah.
And it's like, I don't know what, because they're saying set it for that.
If 80 is like the threshold, you can't have any more than that. Then you would do 30%.
Okay, so
80,
that's the.
And you'd have to your rents could not exceed 30% of 80, whatever the rule was. And then for someone to qualify, they would have to have an income in that band.
Okay. And then you just check up on their income every year and make sure you know who qualifies and who does. Okay. That makes sense. It's interesting, and I don't know why
there has to be a big enough carrot.
Yeah, I don't know why they're not being that specific about,
Probably want flexibility. They may not. Yeah. Who knows how many they'll do. And you can also combine it with green financing, so you can do all the above.
All right, sweet. And there is a community, and we're saying all these like monetary enticements, but there definitely is like a social and a community impact that that's also there. That they can work together. You can help investors make money and help provide housing to people that can't afford it.
Yes. And I mean, it's not a charity. I mean, there are nonprofit organizations that specifically focus on this, and at times you can create larger problems by trying to force altruism, into a competitive space. Typically it's sometimes it works out. I mean, the green rewards programs, there's a lot of money. It's a lot of the way I've seen it typically work out, and that has some very positive effects. But usually, the wealthiest of developers end up getting the biggest benefit from these programs.
Yeah.
Because at the end of the day, they're keeping the rents about. This is for the deal that like it would qualify no matter what. Like they've already bought the workforce housing property.
Yeah.
And so they're basically just like you just kind of keep rents. You can still probably raise rents a little bit, but we're just gonna give you a lower interest rate. And we're going to give you more proceeds, and you're going to refinance into this. And so you're going to take $2 million. So someone's going to do this, and they're going to take $2 million, a couple $1 million of tax-free cash out of the property. Basically, not to not do anything or to say they're not going to increase rents that much.
That's a really good point.
And they're going to sell it, and they're going to make a lot of money. And then, unless the loan's assumed, the next owner can do whatever they want. Yeah. And so I don't know. We'll find out more from the Fannie Mae folks. At lunch tomorrow.
Yeah. Moving on from there, that's what they're doing to kind of address the future. Now, they also have a report out this week, their multifamily and economic commentary. They're talking about the rising number of multifamily properties offering concessions. I don't think that concessions are the real headline here. And I know that's good reporting on Fannie Mae's part, but they've got a far juicier take on the market embedded that is embedded in some of their final comments on concessions, et cetera, and the kind of conditions. Now, I'm just going to quote it because I think it really jibes well with my assessment and what I was discussing earlier in the show. They say, with a robust pipeline of supply expected over the next 18 months, we believe there will continue to be pressure on owners to offer more generous concessions along with lower rents. Combining that new competition with likely unemployment increase and a rental household formation slowdown would likely result in owners using a combination of both options to not only retain their current tenants, but also to gain new ones. And that would include all classes of units, including the more affordable B and C. And ultimately, they say, we believe the forecasted economic slowdown, combined with the robust supply of new apartment units that are underway, will likely add stress to the multifamily sector over the next 12 to 18 months. But we continue to believe the demand for housing will remain, for multifamily housing will remain stable over the longer term due to home purchase affordability constraints and higher interest rates, keeping many tenants moving to home ownership. As a result, we believe that many renters by choice will stay in their units for slightly longer, especially if they're able to take advantage of lower rent levels and more generous concessions.
I mean, if there's ever been, more evidence, to show that, there's some just some headwinds in the market right now. I mean, concessions are the response of asset managers and owners when they see occupancy going the opposite direction.
Yeah,
and they're not seeing the performance they want. What's the one thing that you can do like right away is special. Like, big changes at the property and your systems like that takes a lot of time.
Yeah.
So what are the things you can do? You can increase your marketing and you can offer specials and concessions.
Concessions are they like one-time things? So it's like a one-time bonus of this, and it's easier to grant a concession than to lower a rent?
You can do both.
Okay.
I mean, it can be a one-time discount. Sometimes it's a gift card.
Okay.
Here's $1,000 gift card. It could go on Amazon. It could be a monthly thing. It could be monthly. There's all kinds of different, shapes and sizes.
Okay.
It could be your first month is just free, and so that's kind of baked in.
It's more of a language question.
Or first month free, but really it's just that amount has been amortized over it's how you want to.
Yeah, it was more of a language question. I'm just wondering, what is it that makes a concession of lower rents more attractive to someone than just lower rents?
Toaster.
Okay. Well, okay. And maybe I thought
Keurig machine.
I was thinking more along lines of a lower rent would be like a consistent drag, and a concession is maybe a temporary thing.
It's a race to the bottom.
You got to burn it off. So
because it becomes a feedback loop of the different properties.
Yeah, that's what
Someone else is, the one they're offering $1,000 gift card, and we have to offer $1,000 and a concession and lower our rent.
Yeah, and
again, kind of looping back to, now is the time to buy multifamily.
So yeah, the Fannie Mae comment did talk about a rocky 2024, and I think that really aligns well with what RealPage is talking about too, and they're calling it an unexpected twist of the apartment sector. And Jay Parsons is a little too hard on himself, saying yeah, I saw it coming, but I didn't see it coming quick enough, which is the fact that Class B rents are going down more so than Class A rents when the new supply comes online.
Yeah. Why not go to the Class A at a discount?
Yeah,
I mean, that's the reality, right?
Well, you were talking about concessions, and so Class A, you get so many concessions where suddenly a renter in a Class B is like, well, let me bump up, and that's what they're doing. And then Jay Parsons is speculating, in the future, then the Class C will jump up. This is what we have described, but it is happening at a quicker rate. And RealPage has a graph here that shows if there is less than 1% of new apartments coming on, there's a little gap, or there's B is not affected. But as you go into like 10% new supply, you really see how Class B rents have moved down a little bit more relative to Class A.
Yeah. Well, Matt.
Yeah.
One thing for certain, you're going to have to subscribe to the Great Capital YouTube channel to follow along, learn more. It's going to be We're going to be changes next week. This was great. We didn't have enough time to really get into all the details. But we've got to run, unfortunately.
All right.
Thanks everyone for watching this episode of The Great Report. Again, subscribe to the Great Capital YouTube channel. Make sure that you've liked this video. Leave a comment below, and hop on over to greatcap.net to learn more about what we do. See you on the next time.